So implementing this tax tip, this couple improved their after-tax wealth by $165,000 over a 20-year period. Now, they didn't change the investment performance. They didn't really change anything on the investments at all. All they did was implement this tax tip. Hey everyone, my name is Eric Scheidock from Safeguard Wealth Management, and in today's video, we're going to be talking about 8 tax tips that you can use if you're retired and you're in your 60s to not only save on taxes in the short term, but also through the remainder of your retirement. There are some powerful tips within this video, so let's get started. Now, in the description below, I'll include the timestamps to each one of these tips so you can jump around if you really want to. But I highly recommend watching each of these tips all the way through to gain full understanding of just how powerful each of these tax tips are for your situation. Tip number 1 is delaying Social Security to increase your tax savings over the entirety of your retirement. Now, because of how complex Social Security's taxation is, most people don't think about Social Security as a way to save on taxes, but that's exactly what Social Security is. It's a very tax-advantaged asset. So when we think about how Social Security is taxed, your Social Security benefit at the maximum point will only be 85% taxable. Now, this offers a tax savings as compared to things like pension income or even tax-deferred withdrawals, because 100% of those withdrawals and income is going to be taxable. And so there's a small benefit that you can gain by taking money from Social Security versus some of those other more taxable assets. On top of that, the amount of your Social Security benefit that will actually be taxed is determined by your other taxable income. And so by strategically planning your tax-efficient withdrawal strategy, we can essentially make sure that Social Security is less taxed rather than being fully taxed at that 85% zone. Now, there are 2 key ways that delaying Social Security can help you save on taxes over the long term. First way is just delaying Social Security so you gain a larger benefit and then just have that Social Security benefit fit right into your income goal. So we have an example on the screen right now showing the tax difference between somebody filing for Social Security at 62 versus filing at age 70. So their full retirement age here is 67, and at full retirement age, they would have a Social Security benefit of $28,000. This single filer is looking at taking $65,000 of income. And so if they file for Social Security at 62, they're going to be receiving a reduction in their overall Social Security benefit. And so in total, plugging this into the IRS tax code, this person is going to owe $5,090 in taxes. Versus, let's say that this person delayed Social Security until 70. And so they earned a larger benefit from Social Security. And so by delaying until age 70, this person has $34,720 coming from Social Security. And so their tax liability now is $1,827. And so just from delaying Social Security, this person found a 65% reduction in taxes. And so again, delaying Social Security can offer a huge tax savings on an ongoing basis. But that's only one way that Social Security can be used as a tax tool for your retirement. The second way is while you're delaying Social Security, you open up what we call a Social Security cleanup zone. Let's take a look at what I'm talking about. So if you file for Social Security at 62 and you have some reasonable tax deferred accounts, it will feel good filing for Social Security right away when you retire because after all, you're receiving income from Social Security and you're not having to fund as much of your retirement from your portfolio withdrawals. And because this person has some substantial assets in tax deferred accounts, because they're taking less from their portfolio, what we're going to see is RMDs grow much larger through time. And so by delaying Social Security, what you're basically doing is you're opening up a zone to clean up some of the RMD problems that we might estimate that you have within your situation. So now as you're delaying Social Security, not only are you earning a larger Social Security benefit that will translate to yearly tax savings, but you're also leaving a zone in there where you can take more from your tax deferred accounts, pay a little bit more taxes up front, but then reduce RMDs for the larger length of your retirement. Tip number 2 is using asset location strategies in order to improve your after-tax wealth. Now, this is a very simple strategy, but is one that is very impactful within your situation. So many of us are familiar with asset allocation. That is what we are holding within our investment portfolio. Are we holding stocks, bonds, cash, commodities? But something that is almost never talked about is asset location. Not what are you holding in within your investment portfolio, but where are you holding those given investments? Let's go through an example of a couple that has 2 accounts. They have a tax deferred account and they have a Roth account. Okay, and they're going to be investing in 50% stocks and 50% bonds. Now, when we invest in stocks, we expect longer term growth. Now, we expect that there might be some more risk with investing in stocks, but over the long term, we expect higher growth out of that given asset class. Now, we're typically investing in bonds for safety. We accept a lower yield from bonds, but we gain a little bit more stability. Now, they have $1 million in retirement savings, and $700,000 of that is within a tax-deferred account, and $300,000 of that is within a Roth account. Most people split up that 50% bond and 50% stock allocation into each given account equally. And this makes sense on the surface. After all, we want to have an even split within each account, right? Well, if we're thinking about this through a tax lens, that's not at all what we want to do. Because if we think about it, the tax deferred money that we have, that has a tax liability that's tied to that given account. When we withdraw money from that account, we are going to have to owe taxes on that money. With that Roth IRA account, we don't have any RMDs on that given account. And that account is already an after-tax dollar. And so any growth that we have out of our Roth IRA is going to be tax-free moving forward into the future. So if we were thinking tax first, here's how we'd want to allocate. We'd want to take the given asset that we expect to grow the most over the long term. So that would be stocks. And we'd want to put all of these stocks within the Roth IRA account. Again, for most people's situation, we're probably withdrawing the majority of the money out of the tax deferred account, especially earlier into retirement anyway. And so we want the safety within the tax deferred account. And so that's exactly what we do. We'd put all of the bonds within the tax deferred account, and we'd have a little bit of stock left over that we'd also have to put in that tax deferred account. But the point being, we would have all of the safety, the lower growing assets within the tax deferred account, and we'd have the higher growing assets in the tax-free account. So implementing this tax tip, this couple improved their after-tax wealth by $165,000 over a 20-year period. Now, they didn't change the investment performance. They didn't really change anything on the investments at all. All they did was implement this tax tip, just some simple tax blocking and tackling, and they saw a substantial improvement because of it. Tax tip number 3 is using a tax window of opportunity that is closing soon. So in 2018, the Tax Cuts and Jobs Act was passed. And so two big things changed in terms of tax rates with the Tax Cuts and Jobs Act. The standard deduction for a married couple was raised by about $10,000, and each tax bracket was decreased by about 2 to 4%. Now, this Tax Cuts and Jobs Act that was put into law in 2018 is set to expire in 2026 if Congress doesn't make any changes. Now, this could end sooner. This could also be extended later. So here's what's going to happen. The current 12% bracket is going to become the 15% bracket. The 22% bracket is going to become the 25% bracket. The 24% bracket is going to become the 28%. 32 becomes the 33, and so on. And so right now we are in a window of opportunity that this might be the lowest taxes that we see throughout the rest of your retirement. So there are a lot of tax strategies like Roth conversions that you can be using right now in order to front load your taxes for your retirement and clean up a lot of the tax liabilities that we may see for the rest of our retirement. Tip number 4 is earning a premium health tax credit. So this is one of the most powerful things that retirees, specifically before age 65, can use in order to save on health insurance. So before 65, you only have a few different options that you can choose from for your health insurance. You can take some kind of continuation from work, typically that only lasts 18 months and is generally unsubsidized, so it can be quite expensive. You can use some kind of health sharing service, and if you're in fairly good health, that can be a decent strategy in order to pool healthcare costs together with another pool of individuals in order to translate to some savings. But most retirees will find that ACA insurance, Affordable Care Act insurance, is the best place to purchase insurance from prior to age 65. Now, how much you pay for health insurance on ACA is completely dependent on something called your reported income. And if you report a low enough income, you can earn a subsidy, otherwise known as a premium tax credit. Now, this tax credit can translate to over $1,000 per month in savings alone. Now, there are two ways a premium tax credit helps you save on healthcare costs. First would be the insurance premium that you're paying on a monthly basis, and the second way would be your out-of-pocket costs. And so in the first example, we're going to show somebody who doesn't earn a subsidy. They show too much in reported income. And so what we'll see here with a couple that's not earning a subsidy is that they have some very expensive healthcare costs. On a per month basis, they owe almost $2,100 in insurance premiums. Now, this is based on the silver plan. This isn't all. We'll notice that their deductible is almost $15,000. And when we estimate yearly costs, looking at medium use for healthcare needs, they're estimated to owe $29,916 for the year. And so with earning a subsidy, there's a little bit of a tug of war that happens because you want to report a low income to earn a subsidy, but you want to take the income that you actually want to take in order to live out the early years of your retirement however you ultimately want. The important thing to understand is all normally taxable income, like pension income, tax deferred withdrawals, capital gains, are all counted dollar for dollar against you. Now, there are certain things that aren't counted as reported income, such as Roth withdrawals. Any withdrawals from your taxable account are also only partially counted. For instance, if you take $10,000 from your taxable account, but only $2,500 of that is unrealized gains, well, only that $2,500 is counted against you. And so let's look at somebody who's reporting a fairly low income and thus earning a very large subsidy. So now we see the same health insurance package, that same silver plan, now costs only $35 per month. And notice what happens to the out-of-pocket costs. It goes from $15,000 per year to $4,300 per year. And so now looking at the total annual estimated costs are only about $4,300. And so we can see here that strategically planning for your healthcare costs, specifically prior to 65, is one of the biggest areas for improvement in your situation. This person is saving over $25,000 per year. Tip number 5 is avoiding the widow trap. Now, many of us don't plan on being widowed within our 60s. Hopefully that doesn't come for many decades. But nonetheless, we have to plan for this widow trap within our 60s. We need to plan well ahead of time. We cannot procrastinate. Now, here's what the widow trap is. While you're married, you are under the married filing jointly tax system. You essentially have twice as much room in each bracket than a single filer has. And so as you're taking your given taxable income, it's going to take you longer to span each bracket because of this. So you're going to owe lower in taxes than a single filer with equivalent income would owe. There are also other thresholds within the tax code like IRMA, where a married filer has twice as much room in than a single filer. For those that aren't familiar with IRMA essentially designates that if you show too high of an income, you will owe certain Medicare premium increases, both on Part B as well as Part D premiums. And so the widow trap is created when you go from married filing jointly to one spouse passing away, and then the surviving spouse enters into what we call the widow trap. Now, typically certain accounts like tax deferred assets simply transfer to that surviving spouse. Now, based on the age gap, that person will still have very similar, if not the same, given RMDs, required minimum distributions, on an ongoing basis. They'll have very similar income spanning those brackets, but now they'll have half as much room in each bracket. They'll have half as much room until they meet some of those IRMA thresholds as well. And so what happens is when you go from the married filing brackets to the single filer brackets, as a widow, your tax liability skyrockets. The penalties that you owe based on certain thresholds will skyrocket as well. And typically you see a very large tax increase in the later half of your retirement. And so to avoid the widow trap, we need to have a forward-looking tax plan that estimates what our tax liability looks like through time. We also need to be optimizing our situation for maximum tax efficiency. So that might mean minimizing RMDs. That might mean performing Roth conversions underneath the Tax Cuts and Jobs Act, and while you're still in the married filing jointly brackets. Tax tip number 6 is move to a more tax preference state or live in a more tax preference state for at least 6 months out of the year. Now, within the United States, each state has a different tax code that you are subject to. Some states tax Social Security. Some states have a higher income tax. Some states don't have any income tax. Some states don't tax pensions. So it's very important to know what the tax liability in your given state will be throughout the length of your retirement. A simple way to add tens of thousands, if not hundreds of thousands of dollars to your situation is moving from a less tax preference state to a more tax preference state. And so I just ran a plan for somebody who has about $2 million in investable assets, majority is in tax deferred accounts, and they were looking at the benefit from moving from Minnesota to Texas and eliminating Minnesota's higher state income taxes to Texas's no state income tax. And we found that in their situation, we had an estimated $227,000 in current dollars in total tax savings throughout their retirement. Now, obviously, there is more that has to factor into this decision than just a tax savings. There are other things that are far more important in terms of retirement lifestyle and retirement happiness. But it also doesn't need to be a full binary switch from moving from Minnesota all the way to spending 100% of your time in one of those no income tax states. Could be something as simple as residing in that given state for at least 6 months. Typically with most states, if you stay in that state for more than 183 days, you are considered a tax resident in that state. So what we see a lot of times, specifically in these northern states, is a retiree will spend the winters and snowbird down in some of those warmer, no income tax states. Spend more than half the year there and then reside during the summer up in that northern state. And this way they are establishing a tax resident in that southern state. This can also be used for specifically a smaller period of time. For instance, during this Social Security cleanup zone where we're probably doing a little bit more in Roth conversions and trying to eliminate a lot of those RMDs down the road, so we're paying a lot more in taxes during a 5 to 10 year stretch, we may want to reside down in a no income tax state, take advantage of that no income tax state, and then move back to that higher income tax state after a large amount of your tax liability has already been dealt with. Tax tip number 7 is using your taxable account strategically. So if you have a non-qualified account, a brokerage account, a joint account, a community property account set up, that account can be fairly powerful for your situation, but only if you use it properly. Traditional advice will tell you to spend out of that taxable account first, because generally that taxable account is looked at as a leaky bucket. It leaks taxable income from that bucket each and every year. That can stunt growth within that account and add additional dollars to your taxable income on an annual basis. And so traditional advice will tell you to exhaust that account right away at the first part of retirement. And oftentimes this is precisely the wrong advice for your situation. There are a few ways that you can use this taxable account strategically. So first off, it's important to understand how your income stacks in the eyes of the IRS. On the bottom foundation of your income will be your guaranteed income. That will be Social Security, pension income, whatever your taxable income is, there on the foundation on the bottom. From there, you stack on tax-deferred withdrawals. That would stack on after that Social Security and pension income, and obviously can increase the taxability of your Social Security. And then finally, at last, you would have long-term capital gains that stacks on last. Now, this is preferred because your long-term capital gains are at a preferred rate. For instance, let's say that we have a $100,000 taxable income base. If we take additional IRA withdrawals, we'll be taxed at 22%. But if we take taxable account withdrawals and we pay long-term capital gains, we'll only be taxed at 15%. And so this can be used very strategically within your ongoing tax-efficient withdrawal strategy because the excess income that we have to take, especially if we're being pushed into a higher bracket, we likely want to take from our taxable account rather than our tax-deferred accounts. Where it may make sense to spend from this taxable account earlier in retirement is if you're performing Roth conversions. You have a couple different options for where to pay those Roth conversion taxes from. You could pay those Roth conversion taxes right out of that Roth conversion. If you did a $100,000 conversion, paying 22% in taxes, you would transfer then $78,000 into your Roth IRA. $22,000 would leave and go to the IRS. Now, this is a completely fine way to perform a Roth conversion, but it's oftentimes better to pay out of your given taxable account. And if we think about it, here's what we're doing. We're basically taking money from our taxable account, our less tax preference account, and we're basically shifting it and transitioning more into our Roth IRA account. So if we pay Roth conversion taxes out of our taxable account, essentially what we're doing is we're transferring money from our taxable account into our Roth IRA account. And here's how this is working. So if we're performing a $100,000 conversion and we're going to owe $22,000 in taxes, well, if we pay that out of our taxable account is going to lower by $22,000. But then the full $100,000 conversion is going to transfer in to our Roth IRA account. So in both situations, from paying taxes out of the conversion versus paying taxes out of the taxable account, the same amount is leaving our tax-deferred accounts, $100,000. But different amounts are transferring into our Roth IRA. Paying taxes out of the conversion, only $78,000 transfers into our Roth IRA. But paying taxes out of the taxable account, $22,000 leaves our taxable account, potentially a little bit more if we have to sell a long-term capital gain. But then the full $100,000 gets transferred into that Roth IRA. Tax tip number 8 is one of the most powerful tax tips that you can use in your 60s as a retiree, and that's minimizing RMDs. Now, it's important to know the tax implications of your RMDs by building a forward-looking tax plan or having someone build a forward-looking tax plan for your situation. Now, there are basically 3 core things that you can do in order to minimize RMDs in your 60s. You can spend out of your tax-deferred accounts, you could convert your tax-deferred accounts, or you can plan on giving away your RMDs. So we've already talked quite a bit about spending out of your tax-deferred accounts. While delaying Social Security and while we're in this Tax Cuts and Jobs Act window, we have this opportunity that we call the Social Security cleanup zone where we can spend more out of our tax-deferred accounts and thus lower our RMDs later into retirement. During this zone, we can also perform Roth conversions. So taking our taxable income and either maxing the bracket or maybe even stepping up a few different brackets. But if we have a charitable interest, we don't have to spend all of our tax-deferred assets. We don't have to convert all of our tax-deferred assets. We can plan on giving away some of those RMDs through something called a qualified charitable distribution. So most of the time when we give to charity, we have to give enough to charity to be able to itemize our deductions and have that be a larger deduction than the standard deduction. But a QCD is a little bit different because it's an above the line deduction. Basically what this means is you get to take the standard deduction and still give away that QCD and have that completely be deducted from your taxable income. So let's look at a situation here that we have on the screen. So this is somebody that's receiving an RMD that they don't need. This is an RMD that's excess up and above their income need. They're being pushed through the 12% bracket into the 22% bracket and owing additional taxes on their RMD. Plus they're being pushed into the Social Security tax torpedo. So they're owing additional taxes on their Social Security benefit because as they're taking additional dollars of RMD, they're forcing more of their Social Security benefit into being taxed. And so what we see on the screen here is this person really only retains a very small portion of their RMD, all things considered. They can take that RMD and simply QCD that to a 501c3 and completely eliminate that from their tax situation. And so that charity will then be receiving the full benefit of that given RMD rather than you only receiving a portion of that given benefit. RMDs are the one tax hurdle that can force a cascading issue throughout the rest of your retirement. The reason being is because RMDs are a forced withdrawal. You don't get the option to take those RMDs or not. Here's an example of all of the tax destruction that RMDs can have on someone's situation. So this person turned 72 and they had RMDs that they didn't need. It was up and above their income need. So these RMDs forced them into higher brackets. It also forced them to be subject to Medicare premium increases on Part B and Part D premiums. Now these Medicare premium increases cost them thousands of dollars in extra premium per year. Now, this person had a relatively large taxable account that they carried into their 70s. And because long-term capital gains stacks on last, their large RMDs were pushing any long-term capital gains that they had up into the 18.8% long-term capital gains zone. And so they received an extra tax on their long-term capital gains. Not to mention, towards the back end of their retirement, the surviving spouse would have been subject to this widow trap, thus costing them significantly in terms of increased tax rates. So for a specific retiree, required minimum distributions can really be destructive to your situation. And again, the time to deal with those RMDs is not once you turn 72. It's very difficult to deal with RMDs once you're already subject to these given RMDs because you're constantly playing catch up. Any conversions that you do will be up and above that RMD. And so the time to deal with your RMDs is in your 60s, again, during that Social Security cleanup zone. So as we covered these 8 tax tips for retirees in their 60s, you'll notice that a lot of these tax tips involve a Roth conversion strategy. Roth conversions are extremely powerful right now, specifically in the Tax Cuts and Jobs Act window of opportunity, and to minimize RMDs, to avoid the widow trap, to cover a lot of the tips that we covered within this video. Now, if you're looking at getting the most out of a Roth conversion strategy, click on this video right here where we cover the best Roth conversion timing strategy that you should use in 2022 and beyond. Something as simple as your Roth conversion timing strategy can make a big difference in terms of saving on taxes. Always remember, you don't need more money, you need a better plan. Thanks for watching.